At the age of 93 today, the Berkshire Hathaway CEO is someone people look to for investment and financial tips. Although now a billionaire many times over, Warren Buffett's initial foray into the stock market was modest. At the tender age of 11, Buffett invested in 3 shares of Citi Services Preferred, each priced at approximately $38, costing him less than $120 in total. Since then, Buffett has traversed a remarkable journey and has come a long way since those humble beginnings, amassing a net worth exceeding $100 billion. He stands atop a company valued at over $900 billion. Now, there's a crucial takeaway from this story. You can adopt Buffett's investment approach even if you're not as wealthy as him. In fact, you can begin with just a few $100 or $1,000 saved up. So in this video, we'll hear Buffett discuss how he would invest if he had only $10,000. This video is brimming with valuable insights, so it's worth staying tuned until the end because Buffett's advice provides excellent guidance on initiating the growth of your portfolio. At the Berkshire Hathaway annual shareholders meeting in 1999, Warren Buffett was asked how to make $30 billion. His advice: start early.
Mr. Buffett, how can I make $30 billion?
Start young.
Making money was an early interest for Warren, who sold soft drinks and had a paper route. When he was 14 years old, he invested the earnings from these endeavors in 40 acres of land, hired a farmer to work the land.
Charlie's always said that the big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the snowball, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill.
A key insight gleaned from this clip revolves around the concept of compound interest. While often attributed to Albert Einstein, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. He describes the power of compound interest as building a little snowball and rolling it down a very long hill. As the snowball rolls down the hill, it collects more and more snow until it becomes a huge snowball. Warren Buffett's life and career serve as a prime illustration of its remarkable wealth-building potential. Notably, Buffett didn't attain billionaire status until his 50s, with a staggering 99% of his net worth amassed post-50th birthday. Let that sink in. 99% of Warren Buffett's wealth was accumulated after turning 50. Undoubtedly, Buffett's astute investments, honed since his early days under mentor Ben Graham in New York at age 24, have played a pivotal role. However, his enduring success and global renown are further cemented by his continued adeptness in investing well into his 80s and 90s. Take a look at this chart depicting Warren Buffett's net worth over the years. It vividly illustrates the profound impact of compound interest. Notice how, at age 59, Buffett's net worth stood at $3.8 billion, marking a remarkable $2.4 billion increase from the $1.4 billion he possessed at age 56. Buffett accrued more wealth during this 3-year span than he did in his entire life, leading up to age 56. Furthermore, see how Buffett's net worth surged by over $30 billion from age 83 to age 92. Over these 8 years, his net worth escalated at an average rate of nearly $4 billion annually. He accumulated more wealth in just 1 year than he did in his first 59 years combined. This exemplifies the exponential nature of compound interest, whereby wealth accumulation experiences exponential growth rather than following a linear trajectory. Let's explore the potential of compound interest with a $10,000 portfolio. Allow me to introduce John. John, age 25, has recently delved into the realm of investing and wealth creation. Let's imagine John's $10,000 portfolio is invested over a span of 40 years, with an average annual return of 10%. For context, 10% is typically considered the long-term average annual return of the US stock market. Without John contributing any additional funds, how much do you think his portfolio would grow to by the end of the 40-year period? You might speculate it could reach $50,000, or if he were exceptionally fortunate, perhaps $100,000. However, the reality is even more astonishing. John's portfolio would soar to over $450,000. Through the power of compound interest alone, John's initial $10,000 investment blossomed into a portfolio nearing $500,000. Two crucial factors dictate the power of compound interest: time and return. The key to genuine wealth accumulation lies in maximizing both of these elements. This is why Warren Buffett emphasizes the importance of starting early when it comes to growing a $10,000 portfolio. Consider our previous example with our friend John. By extending the time horizon by an additional 10 years, the investment portfolio surged from $450,000 to nearly $1.2 million. However, if you're not particularly young, don't be disheartened. The most critical step is to commence your investment journey as soon as possible. The other variable that significantly influences the growth of your portfolio is your annual return. Let's imagine John achieves a 12% average annual return instead of 10%. While it might seem like a marginal increase of just 2 percentage points, the impact is substantial. With a 12% return, John's portfolio would swell to $930,000, more than doubling its size compared to a 10% return. Now, let's explore what happens with a 15% annual return. Astonishingly, the portfolio's value skyrockets to nearly $2.7 million. This is mind-blowing how even a seemingly minor difference in annual returns can wield an incredible influence on portfolio size. This smoothly transitions us into the next part of the video, exploring Buffett's guidance on maximizing returns. Buffett has reiterated that if he were managing only $1 million instead of billions, he could guarantee a 50% return annually because of the broader range of investment targets available and less worry about market impact when investing.
It is true. I think I can name a half a dozen people that I think could compound $1 million, or at least they could earn 50% a year on $1 million, have that as an expectation, if they needed it. I mean, they'd have to get their full attention to be working on the sum. And those people could not compound money, 100 million or $1 billion, at anything remotely like that rate.
Reflect on the potency of 10%, 12%, and 15% annual returns in our compound interest demonstration. Now imagine the exponential wealth growth if you could compound your wealth at a rate of 50% per year. There's a crucial adjustment that Warren Buffett would implement in his investment strategy to achieve those exceptionally high returns. He would shift his focus towards smaller companies. You might wonder, why smaller companies? The answer is surprisingly straightforward. Fewer people are giving them attention. To attain high returns, investors must identify companies that are significantly undervalued. As companies grow larger, they naturally attract more attention from both professional and retail investors. Consequently, as the number of investors monitoring a company increases, the likelihood of it being undervalued diminishes. This is what Buffett said if he was just getting out of school and had $10,000 to invest.
I would do it exactly the same way if I were doing it in the investment world. I mean, if I were getting out of school today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums, and there's more chance that something is overlooked in that arena. And as Charlie has said earlier, it won't be like doing that in 1951 when you could leaf through and find all kinds of things that just leapt off the page at you. But that's the only way to do it. I mean, you have to buy businesses or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy them, and you have to buy into good businesses. And that advice will be the same 100 years from now in terms of investing. That's what it's all about.
Imagine you're at a busy market where everyone is vying for the same popular fruits and vegetables. The competition is intense and prices are high due to the high demand. Now, contrast that with a small local market tucked away in a quiet neighborhood. Here, you find a vendor selling a lesser-known but equally delicious fruit at a fraction of the price. Since fewer people are aware of it, there's less competition, and you're able to enjoy a great deal without the hassle of competing with crowds. The same principle applies to investing in stocks. It's advantageous to focus on stocks that receive less attention and aren't closely followed, which often translates to smaller companies. Renowned investor Peter Lynch highlighted another benefit of investing in small companies. On average, they have an easier time growing compared to large companies. Lynch illustrated this with an example. Consider two companies, one generating $20 million in profit annually and the other $20 billion. Which company do you think would find it easier to increase its profit by tenfold? It's likely to be the smaller company. Scaling from $20 million to $200 million implies an increase of $180 million, whereas going from $20 billion to $200 billion entails an increase of $180 billion. There's a limit to the number of potential customers a company can attract, and this limitation makes it challenging for incredibly large companies to grow as rapidly as smaller ones. With this advice, Lynch doesn't necessarily mean that large-cap companies are a bad investment avenue, but he believes the returns on large-cap companies are less due to their enormous size. You might be wondering, this sounds promising, but how can I identify smaller companies? Fortunately, I have the perfect solution for you, the stock screener. A stock screener assists you in filtering companies based on a range of criteria. So, that wraps up this video. I hope you found it informative and enjoyable. Don't forget to give this video a thumbs up and subscribe to the channel if you haven't already. Until next time, take care and happy investing.